Hello, welcome back to the channel. This is Finance Fodder, and today we're going to be covering level 2 of the Wall Street conspiracy theory iceberg. This is going to be a multi-part series, should be at least 9 to 11 episodes or so. So if you like this video, make sure to give it a like and subscribe so you can keep up with what we're going to be covering. A quick refresher for anyone that didn't see the prior video or isn't familiar with the iceberg concept at all. What we're going to do is we're going to use an iceberg to depict a complex topic. The tip of the iceberg is going to be things you're most likely familiar with, and as we get deeper into the iceberg, it's going to be topics that have more complexity. Maybe you do, maybe you don't know about them, and then the further down we get, it's going to just devolve into a bunch of speculation and conspiracy theories and misleading information. So let's go ahead and get kicked off with level 2 here. We'll start with pump and dumps. Well, what are they? Pump and dumps are a form of securities fraud. It's a form of fraud where a person or a group is going to spread false information about an asset, an equity, a security, in order to create a large pool of buyers and artificially increase the price. In these scenarios, the person orchestrating it has already bought the asset at a depressed price, or maybe at a fair price, but they want to find something with low liquidity, so something that doesn't have a lot of buyers and sellers. This is normally penny stocks, micro cap stocks, or you can think of micro cap cryptos. For crypto, it might be something with less than a 50 million or 100 million market cap. It could be larger for a standard stock. The main point is there isn't a lot of liquidity, so it doesn't take a lot of buyers to increase the price a lot. So once they get this large pool of buyers to push up the price, they dump the shares that they had bought before spreading the information on why you should be buying it. And they'll mark the top, and then all the losses are taken on by the retail investors that follow them. A few classic examples of this would be Stratton Oakmont. If you've seen The Wolf of Wall Street, they were orchestrating pump and dump schemes. Enron was considered a pump and dump scheme as well. They were lying about some of their financials, they were lying about some of their investments, and their insiders were dumping stock along the way because they knew it was a farce. There was also a pretty big wave of pump and dumps during the early 2020s. 2020 through 2022, and it involved Chinese microcaps that were listed on NASDAQ. I remember you'd see some of these stocks, they'd get listed, and the same day they'd go up 1,300%. The next day they'd go up 300%. The next day they'd go up 400%. And you'd have these stocks just shoot up, and then they'd crash down 80, 90%. And most of these are delisted at this point. A few examples of them would be Concord International, Top Kingwin, Everbright Digital, and then you also had Phaeton Holdings along with a few others. And this foreshadows a bit into ADRs, which we'll talk about on one of the additional layers. And ADRs has to do with taking stocks from overseas stock exchanges and listing them for US buyers. But for the microcaps mentioned before, these were actually listed on NASDAQ. Now, as pump and dumps relate to crypto, it's a bit more of a gray area. It's not necessarily securities fraud because crypto isn't necessarily a security. Now, fraud itself is still illegal, and some of these examples here do constitute a criminal offense. Others, again, it's a bit of a gray area. One that stands out to me is Squid Token. So Squid Token was a crypto pump and dump where only the creator of it could sell the token. So there was a large social media presence at the time. Talking about the show Squid Games. So you had someone that thought they would profit off of it by making a squid coin. They were able to promote it on social media and get a lot of buyers to push the price up. But what people didn't realize was they could only buy Squid Token. They could not sell it. Now, the reason I say this is a gray area and might not legally be the definition of fraud is Squid Token had a white paper that stated this. It told you it was a meme token. It told you that you could only buy it. You couldn't sell it. So anyone that actually read the white paper, they knew what they were investing in. The problem is people don't actually read the crypto white papers. The type of speculator that these orchestrators are going after don't even know what a crypto white paper is. Moving on, we'll talk about the Great Depression. So the Great Depression was triggered in 1929 in October with a large stock market sell-off. The sell-off ended up lasting right around 3 years. So it went from 1929 to 1932. The average stock dropped by about 80 to 90% during that time. And the markets were ripe with speculation leading up to that crash. There was a lot of leverage in the markets as well. So similar to what we see today in crypto, it wasn't just people simply buying and selling stocks with the money they had. They were borrowing money from the bank to buy stocks with money they didn't necessarily have. And that's what we would call margin or leverage. Margin accounts are still really popular today. They continue to grow. They're a big revenue center for bank brokerages because they're able to charge interest on the borrowed money. So that's not something that's gone away in our markets. It's just become a bit less widespread compared to what was happening in 1929. The stock market crash spooked a lot of investors and actually led to a run on banks. So what happened was, following that crash, people wanted to get their money out of the banks. They knew they were over leveraged. They saw the collapse coming in real time. You know, it's not just companies that are making machinery that their stocks are crashing. It's banks that are crashing as well. So when you see a bank stock crashing, you might want to get your money out. And what happens when everyone goes to the bank at the same time and they try to withdraw money, the bank has liquidity problems because banking is set up in this country and effectively around the world to where they're fractionally reserved, meaning the amount of deposits the bank has is less than the amount of money they have. So if you and 10 of your friends all go to the bank and give them $1,000 and the bank has $11,000 now, they're not just going to keep that $11,000 on hand. They're actually going to create money out of thin air because they are going to take your money and loan it to someone else with the idea that they'll pay it back over time. So a lot of the money that these banks are given, they don't keep it around. You know, they might only keep 10% of the money that's been deposited, and everything else has been lent. And then people take lent money, give it to other banks, and banks take those deposits, and then they turn that into more debt. And you just end up with this system where there's really not as much money in the system as there are deposits. We didn't have FDIC insurance at that point. The money supply was simply wiped out, and it led to a global financial crisis. And there were also some other economic factors at the time that really made this stretch out for as long as it did. Production continued. We had already gone through industrialization. We were getting really good at making machinery, doing it quickly. And the problem with that is you're making excess goods and you don't have any buyers, and no one has the money to purchase anything. At the same time, we were getting into a global trade war. We had the Smoot-Hawley tariffs. That led to a collapse with global trade for us. Additional to that, in the 30s, we had extreme weather conditions that led to a drought in the Midwest, and that's how we got the Dust Bowl. So on top of having financial markets collapse, we also have an international trade collapse because we're slapping tariffs on everyone. While this is spreading across the globe in financial markets, we have a food crisis because there's severe drought in the country. During this time, it was also a period of deflation. So you might think of comparisons to today with leverage and speculation. It was different back then. The money was actually becoming more valuable. If you held your money, that was the best way to preserve your capital. Whereas today, we see that holding cash, we're subject to a lot of inflation, and it's not safe to hold cash. So during that time, a lot of people were holding on to money. They weren't investing back in the stock market, even though it would have been a great time to do it, because the money supply had shrunk. And if you held on to cash, it meant you were actually going to profit. Stocks didn't recover until 1936. That was when the average stock broke even. Now, you got to keep in mind that's the average stock. You have a lot of stocks that outperformed, and you also have a lot of stocks that just went into bankruptcy and ceased to exist. So if you held a large basket of equities and you continued to buy, you did really good. If you held a large basket of equities and you didn't continue to buy, but you didn't have to sell them, it would have taken you about 7 years to break even. It took until World War II for the economy to finally recover. Next on tier 2 is going to be Twitter gurus. Today, it's a better mix than it was a few years ago. Today, there's actually some qualified people on Twitter. You have real businesses, real firms that have a face for their business that will use social media like Twitter, and they'll give sound financial advice. Now, prior to businesses using Twitter and social media, it was mostly just degenerates that were giving out bad advice. And a lot of the times it was for nefarious reasons. They would want to inflate the stock price of what they were holding, which could be seen as a pump and dump. They would also want to create a brand for themselves so they could sell courses. And we still see this today where, people claim they're a stock guru or they're a crypto guru, and they'll try to form different cults around different stocks or cryptos. For example, you might think with the stocks a few years ago, It was really kind of a cult that was formed around GameStop and around AMC. You'll also see this for cryptos. You have these altcoins that have no value. They have an infinite supply. The creator of it owns 80% of that supply. And they promote it on Twitter so they can get enough people to buy it that they can just empty out all of the liquidity and steal money from their followers. And the thing is, they'll continue to do this over and over. And people will participate in it because they understand that it's a pump and dump scheme, but they think that they can time the pump. And the fact that the creator of this is being honest that it's a pump and dump scheme gives them credibility. This is just what happens when you get into an echo chamber. Moving on, we'll talk about R Stocks. So R Stocks is just stocks on Reddit. It's a Reddit forum for discussing the financial markets. It mostly talks about price and news for different stocks. Throughout the past few years, there's been some questionable moderation on there. There's been enforcement of some policies while not enforcement of others. A lot of times, certain stocks aren't allowed to be talked about. Maybe certain strategies aren't allowed to be talked about. But sometimes you'll see exceptions for certain stocks. They'll get posted about on repeat. And a lot of people theorize that, well, the mods, themselves, they want to orchestrate pump and dumps. And that's why some small cap stocks they'll allow talk of and others they'll silence. It's a potential breeding ground for pump and dumps in an echo chamber just due to the fact that you have a niche group of users that are all interested in the same topic, and it is moderated to where only certain information is allowed to get through. So it definitely has the potential for only certain narratives to be able to be spread there. Going one step further would be Discord communities. So a lot of times people will find Discord communities through these Twitter gurus or through Reddit on stocks or Wall Street Bets, which we'll talk about Wall Street Bets later on in the iceberg. And again, Discord communities are just going to be one step further for creating an echo chamber regarding stocks and crypto. This is where people are going to start falling victim to fraudsters, and they might even collude to participate in their own forms of fraud. You'll have Discord communities where you'll have a group of people that are orchestrating a pump and dump. They are saying it out loud amongst themselves in their own chats, and their victims are the followers of the Discord community that think they're listening to someone that has some sort of knowledge that they're not privy to. These Discord communities will often have the users on board with spreading false information and spreading misinformation through their own social media to inflate the price of the asset that they're holding. Now, a lot of the times this doesn't work for, of course, 90% of the people doing it. So again, it's just the original orchestrators of the Discord community that are able to profit off of this. I imagine there's some Discord community where there is reasonable discussion on stocks and strategies, and there's a lot you can learn from. But as a general rule, they're just littered with users that are going to attempt to scam the other members and commit fraud against them. All right, let's talk a bit about IPOs. So an IPO is an initial public offering. It is when a company, after likely receiving several rounds of private funding, they issue shares to the public for a large and fast cash injection. There's a lot of legal requirements that a company has to follow before they can IPO. They work with investment banks, they work with underwriters to make sure everything is privy. Once the valuation is determined, they're going to take a large pool of institutional buyers to issue the shares to, and then some retail is allowed to buy that as well. And that money goes directly to the issuer that they've received. And then post-IPO, trading is going to be done on the secondary market, which means the issuer, the company, they're no longer receiving the money. It's simply retail and institutional investors trading amongst themselves. Once they begin trading amongst themselves, there's two ways to make money. They can make money via dividends. Most IPOs aren't going to pay dividends. They can also make money through appreciation of the stock. They could potentially even make money from shorting the stock if it goes down. Once a corporation has gone public, if they need more funding, they can issue more shares. One of the things about issuing more shares is it does dilute the shareholder. So for example, let's say you own 1% of the stock. If the company issues 50% more shares than are currently in existence, you will lose 25% ownership in the company. You'll go from owning 1% of the company to 0.75% of the company. So this is something to look out for. You'll see most companies, they participate in this heavily, and there is a ton of dilution that happens. and it's not necessarily good for the investor. Now, going back to the IPO itself, there are some protections put in place to make sure that retail and even the institutions aren't just exit liquidity for the insiders. They'll have lockup periods on the stock, so insiders can't sell for, say, 6 months or 12 months, maybe even a couple years. Regardless of that, there's still, often you'll see with IPOs, there's a lot of volatility, be it on the upside or the downside. And you'll see a lot of people think that IPOs kind of exist as a liquidity event for the insiders so they can dump everything on retail and cash out and ride off into the sunset. This is certainly true for some companies. You'll see a lot of companies, even they will IPO, the stock price will slowly go to zero over the next 5 or 10 years and they'll file bankruptcy. You might think of something like Beyond Meat as an example, though they might have had some initial volatility to the upside. You can also think of something like NKLA, where NKLA IPO'd, it shot up, and then it eventually slowly went down to zero. And we'll talk about NKLA here in a second. But there's also great companies that IPO, and then they crash 80% and recover. I would say the most notable example of that would be Apple. After Apple's IPO, they crashed 80%, and now we see what they've done today. The same can be said for Amazon, and even some more recent companies that have had poor performance post-IPO that have gone up a lot. You can think of stocks like Alibaba, Roblox, and Robinhood. Let's touch on the NKLA Scandal. So anyone familiar with NKLA, it was an EV company that IPO'd around 2019 or 2020, and the CEO was jailed for committing securities fraud. He lied about the capabilities of the company. He lied about the capabilities of the car they were producing. It really was a classic pump and dump. It was easy to prosecute him on. And most of this came to light when Hindenburg put out a short report on him. Hindenburg is famous for putting out these reports on companies, why you shouldn't buy them, why you should sell them, why you should potentially short them. And they tell you what their position is. Most of the time they are short these companies they write the reports on. And what Hindenburg was able to show was that the truck that NKLA unveiled didn't run. All they did was they took the frame of this truck, they threw some wheels on it, and they put it on a slanted hill and let it roll down and pretended that it was driving. So this eventually blew up. It led to the company paying a $125 million fine. It led to the CEO going to jail, and it led to a bankruptcy for the company. Despite that, Trump actually pardoned the CEO of NKLA here in 2025. Moving forward, we have level 1 data for stocks. So this is going to be the most basic data you have regarding a stock and its price. So what you'll see is you'll see the last price the stock traded at. You'll be able to see the trading volume. So how many shares are being exchanged, how many are being bought and sold. And you'll be able to see what the best bid and ask price is. So this will be worth talking a bit about what bid and ask is. So what you have when you buy or sell a stock are market makers. And a lot of times market makers, they'll attempt to stay neutral on the price of the stock. They'll be what we call delta neutral. And they don't want to profit off the stock going up, or they don't want to profit off the stock going down. They want to profit off the discrepancy in price between buyers and sellers. So that discrepancy is the spread. The spread is between the bid and the ask. So the bid is what the market maker is willing to pay for the security, which is a lower price. And the ask is what they're willing to sell the security for, which is a higher price. So let's say, for example, Apple stock, the last price it sold at is $100. Well, a market maker might bid $99. They're willing to buy it for $99. So you can sell it for $99. And if you'd like to buy it, they're asking for $101. So you would have to pay $101 to get it, but you'd only get $99 if you sold it. And that $2 difference in price is the spread, and that's how the market maker would make their money. We'll talk a bit about market makers further along in the iceberg. Then we have due diligence. Due diligence, or DD, you'll see this term floating around a lot on Reddit or Twitter, or even YouTube. It's just a term to describe doing your own research on a stock. A lot of times people will give their opinion on a security. Maybe they hold it, maybe they don't. They tell you to do your own DD. That way they're just not responsible for your losses. And it's a good piece of advice. You shouldn't just be listening to someone online and taking stock advice from them because you potentially trust them for one reason or another, or maybe they've had some good picks in the past. It's always on you to do the research and understand what you're putting money into. Next up is going to be swing trading. So swing trading is buying and selling securities based on perceived price ranges they're going to bounce between. It's a form of momentum trading, and we'll talk about momentum stocks later on in this series as well. But the idea is you might have a stock that is quote unquote trapped in a range. It might trade between $60 and $70, and someone will say, oh, well, for 6 months, this stock is traded between 60 and 70. So next time it goes down to 60, I'm buying and I'm holding until it goes to 70. And sometimes this works, sometimes it doesn't. It's not any kind of fundamental analysis. It has to do with technicals. People will do this on stocks that are cyclical. You can think of something like oil and gas, or they'll do it on something that's just highly volatile, like shipping stocks. They might also do it on stocks that are relatively stable. They don't have any growth going on, but the price isn't just going to stay $100 for the most stable company with no growth you can find. There's still going to be a mix of buyers saying, oh, well, I think it's worth 95. Oh, well, I think it's worth 105. Maybe it averages 100. But these people will trade on momentum to try and buy low and sell high. Here we have ESOs. So ESOs are going to be employee stock options. Employee stock options are how CEOs have such low salaries. This is how you see, someone like Mark Zuckerberg will pay himself $1 for a salary, and then he's worth billions of dollars. So employee stock options are offered as incentives on top of bonuses and standard salary for mostly leadership and executive members of a public company. It can be done for private companies too. It's just less liquidity. Employee stock options is a form of issuing more shares. It's not typical that a company would buy shares on the open market, then issue those to the executives. They'll just create shares out of thin air and issue with them. So it is dilutive to the shareholders. And ESOs have a vesting period. Typically, this is multiple years. And the idea is to incentivize the people being compensated in ESOs to stick around and do what is best for the company to maximize their own compensation. And the fact that they do have the lockup period means they're not just going to dump the shares immediately on the stock, and they might be paid out monthly or they might be paid out quarterly. So it'll create, like a stacking or a laddering to where, maybe you get paid $100 million worth of ESOs over the next 3 years, and that's, an amount you get every quarter, and they all vest every 3 years. So, it would really take 6 years to sell everything. It wouldn't just be an influx on day one. They all vest in 3 years and you sell them. Next up is going to be Stock Twits. So Stock Twits is an online forum for discussing stocks. Everything on there is mostly related to commenting on the stock. People will say whether they're bullish or bearish on it. It's known for being full of bots and having people attempting to manipulate prices on there. You'll see spurts of artificially inflated conversations on certain stocks, potentially before or after large news events or large earning calls. There have also been a couple examples on there where CEOs of the company have gotten into arguments with different commenters on there that have, been talking trash about them or about their company, and that can be entertaining as well. Again, Stock Twits is going to be a form of entertainment. Sometimes there's some good information on there, but mostly it's going to be trash. It's going to be similar to the comments on Yahoo Finance. And people often accuse hedge funds of being the ones that do the commenting or set up the bots to manipulate people into either buying a stock or selling a stock. And of course, that would be getting retail to do the opposite of what the hedge fund is doing so they can profit off of their demise. Then we have bearish and bullish. These are just descriptors of trends in the market. If something is bearish, it's towards the downside. So, for example, we saw a few months ago in early 2020, we had the influx of tariffs, and that was seen as a bearish signal. And we saw stocks plummet 20% in a near record rate. An example of bearish news would be if a company misses on their revenue target or misses their earnings per share. It could also be if a company is forecasting lower growth than they had the quarter prior. A bullish trend would be a trend to the upside. So you'll actually see on Wall Street, they have the Wall Street Bull, because of course, Wall Street traders want the stock market to go up. As a generalization, some of them don't, some of them are short. Example of bullish news would be a company exceeding their expected earnings per share. It could be them raising their forecast or raising their guidance for future quarters. Another example could be, let's say Meta had a 12% increase in user count quarter over quarter, and they were only expecting 7%. You'll also see bearish and bullish used a lot by technical traders. They'll draw flags and different trend lines. And we'll talk a bit more about technical analysis later on in the series, but just keep that in mind as we go through here. We'll continue to use this vocabulary. Next up is going to be value investing. We talked a bit about investing itself in the last episode. Value investing is going to be when people are looking for companies that are ideally trading at deflated prices. Some of the classic ways to look at that is price to earnings ratio or price to sales ratio or the book value of the company. The idea being with all of these, the lower the ratio, the more attractive the company is to a value investor. So for example, if you have United Healthcare trading at a price to earnings ratio of 10, and all of their competitors are trading at a price to earnings ratio of 50, the value investor might say it looks like a good value compared to the peers and buy it. That's a massive oversimplification. There's a lot more areas to look into for value investing. A lot of it also has to do with growth in cash flows, growth in earnings, but that can sometimes come across more as growth investing depending on who you're talking to. Then we have Webull. So Webull is a Robinhood competitor. It was highly promoted on YouTube between 2020 and 2023 or so. Similar to what we talked about with Robinhood prior, as with any kind of new brokerage, they are going to be subject to some scrutiny. They are going to have to pay some fines just because the rate that they were growing at, you can't just adhere to everything. It's pretty much impossible. But FINRA did fine them for not appropriately supervising influencers. They also had some deficient anti-money laundering reports. The biggest thing that happened with them was the US government thought they had questionable ownership and potential influence from the Chinese government. There was obfuscated ownership, and this actually led to suspension of their crypto trading between 2023, but it's been reinstated in 2025. Well, that is going to be a wrap for level 2 of the iceberg. Leave the video a like, subscribe to the channel, and stick around for the next levels. We're going to be going into more and more detail, getting more so on the conspiracy side of things, so things are only going to be getting better going forward. Thank you all for watching.